Here we go. Part 4 of our 100 question mega pack for the year 2026 to get you all ready for that real estate broker's or real estate salesperson's license in every state. This is going to work everywhere. So focus in on these questions and good luck with your studies. If you have any questions, leave them in the comments, and we love to help our students get through this examination, and we love to hear that you guys are passing. So without further ado, 25 questions. This is question number 76 through 100, part 4. We'll see you on the other side. Question number 76. Which federal law created the Superfund to remediate hazardous waste sites? Letter A, CERCLA. Letter B, HUD Act. Letter C, Clean Air Act. Letter D, RESPA. And the answer? Letter A, CERCLA. So CERCLA stands for the Comprehensive Environmental Response and Compensation Liabilities Act. And so it is the flagship environmental law on the federal level. It was basically created something known as the Superfund. The Superfund is a bunch of money set aside in the event there is some sort of environmental catastrophe on U.S. soil. And what it does is we can go to the fund to clean up the problem and then figure out who did it, and then we can send them the bill. And so CERCLA is also known as the Superfund. You want to know that? And you want to know that its primary function is to remediate hazardous waste sites. And so CERCLA is an absolute thing. Now, the HUD Act has nothing, is not there, it's not real. So that's just, get rid of it. And it has nothing to do with environmental issues. The RESPA law is the Real Estate Settlement Procedures Act that deals with settlements and its procedures. And so RESPA has nothing to do with the environmental issues. And the Clean Air Act is a bit of a red herring. That's probably the number one wrong answer if you were to look at it. So this is definitely out. But if I were to even 50-50 this, I would have A-B'd it to letter A, letter C, and I would have eliminated letter B and letter D, just knowing that HUD Act is just nothing. And RESPA is the Real Estate Settlement Procedures Act. That's not what the question is asking me for. So if I had to guess, I would say that that's it. Then if I had to guess even further, Clean Air Act is sort of this one-dimensional thing compared to what CERCLA is, and I might pick CERCLA. Now, the only problem is if you don't know what CERCLA stands for. So you do need to pair that. And a lot of these letters and initialisms, you want to make sure that you are identifying what it fully stands for. So I know it's a bit of a drag, but you definitely want to know them in their short form and in their long form. Question number 77. What is the principal balance on a $250,000 home purchase with a 20% down payment? Letter A, $200,000. Letter B, $225,000. Letter C, $240,000. Letter D, $250,000. And the answer? Letter A, $200,000. So this is a bit of an interestingly worded question. It's asking for what is the principal balance, making this assumption that you, the student or test taker, has connected some dots. And the connection here is that principal balance, we're talking about a loan, and the principal balance is the balance of the loan. So initially, when we close the transaction, it's whatever the original loan amount is. That's the principal balance. And so we want to be able to make that correlation. So principal balance is making a supposition that there is a loan. And when we purchase a property, the original principal balance is the loan amount. And so here is the purchase price, $250,000, and we put down 20%. So here you can go $250,000. You can multiply that by the inverse, which is 80%. That's going to give you $200,000. And so taking out 20% and then leaving the remainder, that's the remaining principal balance at the time of closing. And so this is an interestingly worded question. Just be mindful of things like this as you're going through to make sure you understand. Question number 78. Which trust account rule is required of brokers? Letter A, placing client funds in a separate escrow/trust account. Letter B, investing client funds for better returns. Letter C, depositing client funds into the broker's personal account. Letter D, keeping funds in a safe until closing. And the answer? Letter A, placing client funds in separate escrow/trust accounts. Okay, there are some things here that if you do these things or somebody does you, they should never have a broker's license. Oh my goodness. Like keeping funds in a safe until closing. Whoa. And then investing client funds. Oh yeah, that's a great idea, right? So the letter B and letter D is clearly one of these questions where they're going to give you two stupid sort of comments here that really are irrelevant and clearly wrong, and you can immediately eliminate them. Hopefully you'll get some of these through and peppered throughout your exam. Now, don't be shocked, by the way. There are some really, really poorly written test questions. I'm sure some of you will have some case studies about how poorly sometimes these questions can be written. Okay. Not trying to bash on anybody, by the way. Anyway, placing client funds in a separate escrow trust account, that is the textbook requirement of trust accounts when it comes to brokers. So A, all day long. And then just to compare C to it, depositing client funds into the broker's personal account, like, yeah, that's not going to happen either. So B, C, and D are clearly ridiculous. A is the only logical answer here. It's a straight up question. I do appreciate these types of questions because you will occasionally see them peppered throughout actual examinations, and you'll find that you're like, wow, that was like a give me easy deasy answer. Question number 79. Which lease is most common in residential housing? Letter A, gross lease. Letter B, net lease. Letter C, ground lease. Letter D, percentage lease. And the answer? Letter A, gross lease. So the gross lease is the most common in residential housing. The tenant pays a fixed amount of rent, and the landlord pays all of the other expenses, including things like real estate taxes and upkeep and maintenance, etc. So it is gross rent in residential transactions primarily. And then in a lot of commercial and retail transactions, it's a net lease or a percentage lease. So it could be net lease plus, where the tenant not only pays a net profit rent to the landlord, but also covers all of the expenses associated with the operation of the property. And so we call these net, or we call these triple net. You'll find these types of definitions in your leasing chapters, so do review them. In addition to the state-specific real estate, landlord, tenant rules and regulations, which many of you will see on your actual state portions of your exam. Question number 80. Which type of depreciation is caused by external factors like nearby factories? Letter A, deferred maintenance. Letter B, functional obsolescence. Letter C, physical deterioration. Letter D, economic obsolescence. And the answer? Letter D, economic obsolescence. So this is straight from the three types of depreciation inside of any valuation sections that you're studying. These are typically in the basic valuation sections. And so you're going to want to know these in the cost approach to valuation. So there's the substitution or the income approach, then there's the market data approach or the sales comparison approach, and then there's the cost approach. And inside of the cost approach, you're going to find these three types of depreciation when it comes to valuation loss, value loss in real estate valuation, okay? And so when you see these, you want to know them. You want to know what deferred maintenance, you want to know functional obsolescence, physical deterioration. So the actual depreciations are B, C, and D. And deferred maintenance is an example of something that you do inside of physical deterioration. And so that's what deferred maintenance is, the solution, one of the solutions to a physical deterioration, something that's cost allowing. And so, cost permitting, you make certain, items like, paint and updating certain things, and those types of, general expenses towards deferred maintenance is going to start to slow down the loss in value because of physical deterioration, right? So those two are paired together. Functional obsolescence is when there's like an outdated design feature inside of the property. For example, you have a 5-bedroom house with only 1 bathroom. That'd be kind of rough, right? So that home suffers from a functional obsolescence. And then the only other one is the economic obsolescence. Now, sometimes they call this an external obsolescence, And what the test writer did here is instead of calling it external obsolescence, they called it economic obsolescence because we can still use it. So it depends on who's writing it, depends on who's teaching it, and sometimes they'll refer to it as external obsolescences or economic obsolescences. And either way you cut it, they're the same difference. They're things caused by external factors. So they didn't make it easy for you and put external and connect the words external to external. Instead, what they did is they threw an economic obsolescence to kind of throw people off. And then nearby factories. So some people would even miss the word nearby factories and go pick something else. So you want to make sure that you're reading this very carefully. This is a great example of how they can twist different words and use different phrases, which means the same thing. So definitely check this stuff out as you're studying. Question number 81. Janet inherits property for the duration of her life. What type of estate is this? Letter A, life estate. Letter B, leasehold estate. Letter C, fee simple absolute. Letter D, defeasible fee. And the answer? Letter A, life estate. Okay, so this is pretty textbook for a life estate. You want to know what life estates are? And all of this stuff, leasehold estates, fee simple absolute, defeasible fee estates, these are all legitimate estates. And you want to know that they're real. You'll find all of these in sections known as interests in real property. It could be that. It could be estates and land. It could be property, land, rights, something like that. So look across your materials and you're going to find these. You want to know the definition of all of these. Fee simple absolute is the highest form of ownership recognized by the U.S. law. A defeasible fee has some kind of condition. So you might see phrases like so long as, right, or a while. And then a lease estate is where you're leasing something. And then a life estate is it lasts for the duration of somebody's life or for the life of another. So you want to know all of these. You want to know a conventional ordinary life estate, and you want to know a per autre vie life estate as well. Question number 82, which is an example of commingling? Letter A, broker keeping escrow records for 5 years. Letter B, broker placing personal funds in client escrow account. Letter C, broker placing earnest money in trust account. Letter D, broker returning unearned commission. And the answer? Letter B, broker placing personal funds in client escrow account. So commingling is an absolutely gonna be on your real estate examination type of vocab phrase. So you're going to learn this inside of the brokerage chapters, the agency chapters in that section, sort of like in the very beginning. You'll find it somewhere. Commingling is mixing brokerage funds with client funds. So it's mixing those two, or mixing escrow funds with other funds. So commingling is prohibited, okay? So commingling is not allowed. We have to keep our money separate. Brokerage, client funds versus brokerage money. So no commingling is allowed. So broker placing their personal funds in a client escrow account is pretty textbook for commingling. You want to know this for sure. And then questions like this, you'll notice broker keeping escrow records for 5 years. Some states have 5 years, 3 years. That's state specific. Don't worry about this for this particular training. This is national exam concepts and brokerage generally speaking. Brokerage placing earnest money in a trust account, that is legit. That is okay to do. That is what you're supposed to do. That is the opposite of commingling and sort of sorts. And then broker returning unearned commission has nothing to do with commingling. If you're taking it out of your brokerage account, that's completely fine. So this, letter B, is the answer. Question number 83. What is the difference between market value and assessed value? Letter A, market value is what a buyer will pay. Assessed value is for taxation. Letter B, market value is used for taxation. Assessed is used for appraisals. Letter C, market value is lender's estimate. Assessed value is appraiser's estimate. Letter D, no difference. They are interchangeable. And the answer? Letter A, market value is what a buyer will pay. assessed value is for taxation. And fundamentally, that's the answer. I mean, the truth, there can be convergence between the market value and the assessed value. There could be divergence. Many times there is. Many times you're underassessed, you're overassessed. Your market value is really a representation of what the market will allow you to buy and sell for in sort of a regular or normalized market environment. And sort of that's the fundamental difference. You will find these phrases inside. Primarily, you'll find the market value instead of the appraisal section. And then the assessed value you might find in the liens section. They might talk about tax liens. They might talk about assessed value. It really depends. I've seen it all over the place with all the various publications that are out there. Our material places it in a pretty logical space. So look for it and know the difference in these definitions. They're going to serve you well. Question number 84. Rob buys an investment property generating $24,000 in annual NOI, net operating income. If similar properties sell at 12% capitalization rate, what is the property's value? Letter A, $200,000. Letter B, $180,000. Letter C, $220,000. Letter D, $240,000. And the answer? Letter A, $200,000. All right, so this is going to be found typically inside of your appraisal sections in the income capitalization approach. So this is very standard there. You want to learn about cap rates. You want to learn about the different variations of the equation to figure out the value of a property. So for here, you want to understand that if you see a net operating income, whatever it is, it's very simple. You just got to take the net operating income and divide it by the cap rate. So this is divided by 12%. So for those that don't know, that's okay. All you have to do is 12% is 0.12. Okay, you're going to do that mathematics, and you're going to get $200,000 in valuation. So a property that's worth $200,000, generating $24,000, in annual net operating income, has a cap rate of 12%. So there's a direct correlation between all of these numbers when it comes down to cap rate. You want to study the capitalization rate to make sure you understand how to do it. And you also want to remember certain little things like, what are operating expenses? How do I get from an effective gross income down to the net operating income? So you want to know how these are calculated, and you'll study these, and you're going to want to do a basic analysis, with the one trick being the mortgage payment. And I'll leave that up to you to study, but you want to make sure that you know all of those components before you take the exam. Question number 85. Which of the following is an involuntary lien? Letter A, HELOC. Letter B, reverse mortgage. Letter C, judgment lien. Letter D, first mortgage. And the answer? Letter C, judgment lien. So in your studies, you will find the difference between a voluntary lien and an involuntary lien. And you're going to want to know the difference. And it's pretty easy. The voluntary liens are done intentionally, and the involuntary liens are done without your permission. So if you don't pay your real estate taxes, then the government has the right to place a tax lien on your property. Those are involuntary. So liens that are placed on a property where I did not want them to be there. Examples would be a judgment lien. A judgment is something that's awarded to a winner in court. And those are involuntary types of liens. A HELOC is voluntary. I apply for a home equity line of credit. It gets approved. A lien is placed on my home. I apply for a reverse mortgage. It is a voluntary lien. And a first mortgage, without anything further explained here, is a voluntary lien. So I'll write V, 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 and this is IV. You want to know some differences between them? Tax liens, real estate tax liens, these are all types of involuntary liens. mechanics liens as well. So you want to know a few of the different ones, and that's going to serve you well.
If you're looking to pass your real estate exam in as little as 2 days, make sure to check out my best-selling 48-hour study plan. This simple 2-day schedule takes a few hours each day. So if you're taking the real estate exam this week, then this is absolutely the product for you. And guess what? It's on sale right now. I'll drop a link
in the description below. Yeah!
Question number 86. Which method of legal property description uses physical features and compass directions to outline property boundaries? Letter A, lot and block. Letter B, government survey. Letter C, meets and bounds. Letter D, rectangular measurement. And the answer? Letter C, meets and bounds. So the meets and bounds type of legal description utilizes a physical feature inside of the properties, and it sort of compass directions to outline the property's boundaries. And these are very standard. There are 3 legal descriptions. Many times the chapter, in fact, is just labeled legal descriptions. And these legal descriptions go inside of any legal documents like a deed or a mortgage, etc. And so there is lots and blocks, there is government survey, and there's the meets and bounds. Now, something that it did do here is it mentioned the rectangular measurement, and there is no legal description per se called the rectangular measurement, but there is one called the rectangular survey. And that's the same as the government survey. So sometimes on some exams, on some books, in some like jurisdictions, they'll call it rectangular survey and some will call it government survey. That's all good. So these are the 3, 1, 2, and 3. And the meets and bounds is the only one that uses the property's physical features and compass directions to describe the property's boundaries. And this is a really decent way of explaining this. This is popular. I wouldn't be shocked if you see something like this on that test. Question number 87. Joseph is selling his home. He installs new appliances but does not intend to include them in the sale. How should he proceed? Letter A, remove them before listing. Letter B, do nothing because they are personal property. Letter C, ask the appraiser to exclude them. Letter D, list them as fixtures. And the answer? Letter A, remove them before listing. So the trick here is this person is selling their home. They install some new appliances, but they do not intend to include them. So in that case, what is typically the best way to do it if you don't want to include the appliances? Now, there are some reasons where appliances installed are requirements. So like a stove in a kitchen is a requirement. A refrigerator is not, but a stove or a cooktop is, and for a legal kitchen. So in order to not violate the occupancy certifications, then you're going to need to install certain things. But again, I'm giving you a little bit more than you need. The question didn't give you all of that depth, so don't overanalyze questions. Be very, very careful. In this, it's pretty straightforward. It's saying, hey, this person is putting in new appliances, but they don't intend to include them in the sale. What should they do? Well, the most correct answer here is remove them before we list, because there could be problems if we list it. There could be problems in taking photos. You know, you don't want to just do nothing, because then they could be conceived as parts that are staying with the property. You don't want to ask the appraiser to exclude them, and you don't want to list them as fixtures, because that's not going to change anything either, because we want to make sure that they are personal property, not personal property that's converted into real property. So this is the best answer. Good question. Question number 88. A buyer purchases a home and later discovers an undisclosed lien. What protects them? Letter A, title insurance. Letter B, appraisal. Letter C, closing disclosure. Letter D, a general warranty deed. And the answer? Letter A, title insurance. This is classic. So title insurance protects against several things. There are two types of policies. There are standard policies and there are extended policies. You want to know that. And you also want to know that they are purchased one time and the premiums are paid one time at closing. There are lenders title insurance policies known as the mortgage ease title insurance. And then there are buyers or the new grantees title insurance policy. And these are going to be there. There's going to be a list in many of your books, and it will identify what they typically protect. And it is important to note here that buyer's title insurance is going to protect against undiscovered liens. And that's one of the big things that it does protect against. So you want to know that for your exam, and we call this title insurance. Question number 89. Which lease type is often used for long-term ground rentals, such as commercial development or leased land? Letter A, net lease. Letter B, ground lease. Letter C, gross lease. Letter D, percentage lease. And the answer? Letter B, ground lease. So these are all legitimate leases: net lease, ground lease, gross lease, and percentage lease. I would study these and know the definitions for sure. You're going to see these. Remember, net could also be triple net lease. Do watch out for net listing when they try to throw that in. Ground lease is a legitimate thing, and this is what question 89 is asking you. A gross lease is typically used in residential transactions, and a percentage lease is used in retail. Now, which type of lease is often used for long-term ground rentals? That was like the telegraph, and that would be a ground lease. Now, a lot of students will be like, oh, that's too obvious. I'm not going to pick that if you don't know it. So therefore, you need to know the definitions here of these four types of leases. Question number 90. Which federal law requires that borrowers receive a booklet about settlement costs and prohibits kickbacks? Letter A, RESPA. Letter B, TRID. Letter C, ECOA. Letter D, TILA. And the answer? Letter A, RESPA, stands for the Real Estate Settlement Procedures Act. TRID is the TILA RESPA Integrated Disclosure Rule. This one deals with the loan estimate and the closing disclosure. ECOA is anti-discrimination, anti-D, and then TILA is the Truth in Lending Act, also known as Regulation Z, and it deals with things like APR and truthfulness and advertising. And so the Real Estate Settlement Procedures Act is the federal law that requires borrowers receive a special booklet about settlement costs and prohibits something called kickbacks, which are unearned fees that are paid for referral of business. So, for example, if a real estate agent refers business to a loan originator, or if a loan officer refers business to a title company for closings, then these are violations of the Real Estate Settlement Procedures Act under certain conditions. And so RESPA prohibits kickbacks. And one of the things that it does is it requires that a borrower receive a booklet about the different settlement costs associated with real estate closings. Question number 91. Which approach to valuation is most often used for special use properties like schools or churches? Letter A, competitive market analysis. Letter B, sales comparison approach. Letter C, cost approach. Letter D, the income approach. And the answer? Letter C, the cost approach. So when we have unique types of properties, things like special use properties, schools, churches, unique properties, we're going to use the cost approach. The cost approach will carry the most weight in those types of properties. Now, if we're talking about residential property valuation, like two residential properties or like a residential property in 30-year-old house, then we're going to use the sales comparison approach because that represents the market. A competitive market analysis is what a real estate professional performs in order to give a potential client looking to, solicit listings what their property could be worth. The income approach we obviously use for income producing properties. We looked at a previous question about net operating income and capitalization rate. But the cost approach is our answer. You're going to find these inside of the appraisal sections of your book. Study these. Now, with cost approach, also remember there are several types of depreciations. There are 3. You want to know these for that test. Question number 92. A buyer is purchasing a property described as Lot 7, Block B, Maplewood Subdivision, recorded in Plat Book 12. This is an example of which legal description method? Letter A, meets and bounds. Letter B, lots and blocks. Letter C, government survey system. Letter D, lots and surveys and plats. And the answer? Letter B, lots and blocks. So we want to know the lots and blocks, the meets and bounds, and the government survey system. And this is sort of really easy. Lots and blocks, what we're looking at right here. So the lots and block system is the one that we're looking for here. And this is telltale. Lot 7, Block B. So this is the lots and blocks method. The meets and bounds uses directions and monuments. And then the government survey system is using latitude and longitudinal lines. And it's using, sections, and it's using townships, etc. So the government survey is a little bit more in depth. The lots and surveys and plats, that's just a wrong answer. And the answer here is lots and blocks. You want to know the definition of these 3. And remember, this one here can also be called the rectangular survey system. Question number 93. What does the term principal mean in agency relationships? Letter A, the fiduciary. Letter B, the customer. Letter C, the client. Letter D, the agent. And the answer? Letter C, the client. So, the principal in agency is also referred to as the client. And the client is the party that we work for. And so you want to know that we work for the principal, also known as the client. The customer we work with. A fiduciary is the role that the agent plays, giving care, obedience, loyalty, disclosure, accounting, and confidentiality. And then the agent is the agent, right? So that's sort of the breakdown here. All of this you will find in the agency section or the brokerage section of your study materials. We'll see you in the next one. Question number 94. Which property right gives the owner legal use of underground minerals? Letter A, air rights. Letter B, mineral rights. Letter C, water rights. Letter D, riparian rights. And the answer? Letter B, the mineral rights. So, mineral rights, also known as underground minerals, it gives us the legal use to have those. Anything above the land is air rights. Those are real things. And water rights. We learned about riparian rights and littoral rights and doctrine of prior appropriation. All things that are legit under property ownership. You would probably find these in your books or your study materials. You definitely want to know these. This is maybe a simple one question you may see on this. I would be very, very shocked if you see many, many more. Question number 95. Which of the following is considered a material fact? Letter A, that the roof leaks during heavy rain. Letter B, that the seller's reasons for moving. Letter C, the seller's urgency to sell. Letter D, that the property has outdated paint colors. And the answer? Letter A, that the roof leaks during heavy rain. So, the definition of material facts. Material facts are information relevant or extremely important to the transaction. Missing or lacking those facts could adversely impact the outcome of the transaction for either party. And so we have to disclose material facts and material defects. And material defects would be something like lead paint exposure. Material facts, and this that the roof does leak, that is a material fact, which is also a material defect. These have to be disclosed. And so therefore, in terms of disclosure, all material facts and defects must be disclosed. The seller's reason for moving is not material in nature. And the seller's urgency to sell is also, it might seem like it's important, but it's also irrelevant. It's not considered a material fact. As a matter of fact, those are things that are left confidential. That the property is outdated paint colors, that's not material in nature. The paint colors are visible, and that is they're ugly. It's a patent defect versus a latent defect. But any latent defects or hidden structural defects would be material in nature, and those do have to be disclosed. Question number 96. A property measures 120 feet by 150 feet. How many square feet of land does it contain? Letter A, 18,000. Letter B, 16,500. Letter C, 15,000. Letter D, 12,000. And the answer? Letter A, 18,000 square feet. So this is really, really simple. To get square feet, all we must do is multiply. So 120 times 150, and that's going to give you 18,000. Very, very straight. And then the unit of measure is square feet. Okay? Feet squared or square feet. And that's pretty simple. So that's, you may see that, something like that on an exam. Question 97. Which of the following transactions would require the use of RESPA disclosures? Letter A, residential loan from a federally related lender. Letter B, commercial property purchase. Letter C, cash purchase of a condominium. Letter D, 25-acre farmland purchase. And the answer? Letter A residential loan from a federally related lender. So this is a bit of an obscure question. If you look at federal laws that deal with lending, and RESPA is one of them, the Real Estate Settlement and Procedures Act, you'll read a little bit on RESPA. Many real estate books have little write-ups about it. Some have a little bit more than you need. One of the things that you will see oftentimes is what are the required or the covered transactions under RESPA. And so to boil it down, something very simple is RESPA deals with residential transactions. So if it's a commercial property, like one of the answers here, RESPA doesn't have the jurisdiction on it. If it's a cash purchase of a condominium, RESPA doesn't have jurisdiction on it. And if it's 25 acres or more, then RESPA does not have jurisdiction over that. RESPA has jurisdiction over residential loans if it is a federally related lender. Federally related simply means that some federal institution has oversight and deals with them. So it could be somebody overseen by the Officer of the Comptroller of Currency, somebody, these are federally registered or federally chartered institutions. And that's what RESPA is covering. And that's something you want to know. As a matter of fact, if you can just memorize this question and know what RESPA does not cover, like B, C, and D, you're good to go. Question number 98. What does a promissory note represent? Letter A, the borrower's personal promise to repay debt. Letter B, the mortgage itself. Letter C, the lender's guarantee of financing. Letter D, the collateral for a loan. And the answer is letter A, the borrower's personal promise to repay debt. So there are two documents, the promissory note and the mortgage. The mortgage is evidence of a lien. The mortgage is a lien. And that's the mortgage. The note is simply the borrower's promise to repay. And that's literally it. That is an important distinction to make. You do want to know what a promissory note is, and you want to know what's going on. Now, the mortgage itself is a separate document. The lender's guarantee of financing is not what a promissory note is. That is the loan commitment. And then the collateral for the loan is the property, the asset, which the lien or the mortgage is placed on. And so letter A is what the definition, a very reasonable definition of a promissory note. Question number 99. Which appraisal principle explains why adding a luxury pool may not increase value by the cost of construction? Letter A, contribution. Letter B, substitution. Letter C, highest and best use. Letter D, progression. And the answer? Letter A, contribution. So these are the economic principles of value. You will find these in the appraisal section, typically in the beginning parts, about sort of defining what is market value, what is cost, what is value, and you'll see these economic principles. Contribution is one of that. And you want to know that, depending on what the installation is, what the improvement is, it may not contribute as much to the property as other contributions. So for example, if I'm adding in a luxury pool, it may not increase the value to the cost of the construction. It will add value if other properties in the area happen to have that amenity. But a updated bathroom, a gutted kitchen, those are going to contribute a lot more because of the function of the room compared to sort of the desirability compared to what the cost of the construction is if you're gutting a kitchen or adding bathrooms. So those are going to contribute a lot more to the value compared to a luxury pool in this example. Substitution is an economic principle, but it's not the correct answer. Highest and best use is the maximum profitable use of the property. Progression is having a modest home in an area where there's lots of big properties, and your property tends to be valued around the same prices as the bigger, more luxurious properties. Question 100. Which type of depreciation can usually be corrected most cost effectively? Letter A, physical deterioration, curable. Letter B, functional obsolescence, incurable. Letter C, economic obsolescence. And the answer, letter A, physical deterioration, which is curable. Okay, so these are the different types of depreciation. You will find these depreciations in the cost approach to value. All right, so first off, you want to know that. Now, economic obsolescence is also known as external obsolescence. So these are happening for forces around your property are reducing its value. So it could be like a neighborhood with bad crime or something like that, where your value is being affected and there's little you can do. It's incurable. So this is something that you definitely want to know. Economic obsolescence is always incurable. In other words, you can't fix the externality issues. The externalities just have to be fixed. Now, which brings us to what is curable versus incurable. A curable issue or item is something that the economics, if you were to pay for it, it would be recompensed. You could get your money back. So in other words, if I spend some money improving the property by simply painting it with fresh colors, fresh paint, then the cost of the paint will be recoupable when I go to sell the property. So physical deterioration, a drab wall, can be cured economically by buying some paint, which is relatively cheap, and some brushes and paint. And so those are curable issues versus incurable. An incurable item is an item that would be very expensive to fix. Doesn't mean that you couldn't do it, but then the question becomes is if I'm going to spend that much money, will I be able to get my money back? So if something suffers from an incurable functional obsolescence, then that means the cost would not potentially be recovered from the investment into that repair or modification. And you want to know curable versus incurable. And then another big one is the external ones are always incurable. You want to know that. Functional and physical are curable or incurable. All right. 100 questions. There you have it. Hopefully you learned a bunch of things. Hopefully these questions are going to get you through, like the 2025 questions. Like before it, so many students found a lot of success on those examinations. And I can't tell you how excited we are to hear those comments. Now, don't forget, the 2025 questions are great questions. They are timeless. We construct these questions to make sure we get plenty of juice out of it. So things don't really change that drastically over the years when it comes to this particular subject. This stuff will change. Exam content outlines will change and shift a little bit. So definitely check those and make sure that you're focusing in. Listen to the reasoning why answers could be wrong or correct, and you'll find a lot of depth in there as well. The questions are solid, and I hope you find some success out of these in your studies. getting you ready for that examination. We really appreciate y'all for subscribing, and we love the comments, and thank you so much for all of your patronage and all of your dedication. It is a wonderful community that we've built here, and it is an absolute honor and a pleasure to have you. Good luck with your studies, and we'll see you in the next video. See you soon.